This is StewardShift, a show that gives you the tools you need to get the most of your best resources. Your money, your mind, your body, your time.
Welcome back to the StewardShift Show. I am your host, Troy Levy. This is a very important episode because in the midst of death and destruction, and by the way, I'm not an alarmist, but one thing that we do know about life that's certain, of course, we have taxes, but we also have death. And we know that it's hard to go through certain things when death is just present. But there are some things that we can do to make the transition from the death of a loved one very, very easy, or easier. Let's put it like that. And so we have a good friend of mine, life insurance professional and financial representative, Michael Looby. Michael, thank you so much for being our guest today.
Anytime, Troy, anytime.
All right. So, Michael, let's jump straight into this. You are very, very familiar with life insurance. Matter of fact, you have sold life insurance products to so many people. And we just asked some questions about life insurance because I know that there are some in our audience who just have no idea about life insurance, what to get, what not to get. They've heard a lot of chatter out on social media and whatnot, and we'll get to some of those social media influencers soon. But let's start with the basic questions. What's the specific purpose of life insurance?
The actual purpose for life insurance is really to, let's put it like this. Normally when someone dies, there's an interruption in the income stream, right? So if I die, for example, and I can't work anymore, my family doesn't receive that income. Life insurance steps in when I die to continue that income stream so that the family's financial status doesn't change.
So this basically is covering, I think I've heard someone call it death insurance, pretty much. We call it life insurance. Is that kind of like a fancy name so that people don't get scared off by it? But really, it sounds like death insurance.
It's really actually just income protection, because that's the thing. Yes, you lose your loved one. You can't bring them back with any amount of money. But the death of the income is really what's dangerous for most people.
So people's families are able to be protected in the event of, let's say, my demise, God forbid.
Mm-hmm.
So what are the different kinds of life insurances? I've heard so many products out there. And does it really make a difference what kind of life insurance you get?
I was going to say, how much time do you have? Because I looked at all the iterations. I think there's at least 30 iterations of life insurance, but they all fall into the same three categories. You have whole life, which is typically from whatever age you buy it till age 100. Then you have universal life, and it's a modification on whole life, but same idea. It's a cash account with insurance, and that's usually to whatever age, but normally it's to age 120, and then term life insurance. So that's a set amount of time, similar to home insurance or car insurance.
Got it. So I'm hearing till age 100, and another one till usually around age 120 or so, and then another one is just for a specific time that you pay for. Now, as I'm listening to it, getting insurance until age 100 or being covered by it until age 100 or 120 sounds great, right? Like why go with something that is limited as opposed to something that is essentially unlimited or for the rest of your life?
Yeah, I mean, it sounds great. The idea of being able to quote unquote invest or put money aside in an account that lasts until age 100 sounds great until you find out the stipulations, right? So if you take, for example, $100,000 of whole life insurance for the average 30-year-old, probably going to cost them $1,200 a year. Well, if you compare that to a term life insurance policy for the same or similar amount, let's say $150, right? That's going to probably cost $300 or $350 a year. So $1,200 a year versus $350 a year, it's not hard to tell which one is going to be more economical for the family.
So if perchance you outlive the insurance, what happens there? And like, is there a way or strategy for buying insurance so that if perchance you do outlive it, and we always hope that we do outlive it, but how do we handle that there?
I get that question a lot, Troy, because people say, well, Michael, I don't have anything to show for it if I outlive my insurance. Whereas whole life, doesn't matter what age I am, I'm going to have it. And I say, well, let's put this scenario together. Let's go back to that 100 versus 150. So that $1,200, right? And let's say 300, that's a wide gap, right? But what you can do is, what I recommend is all the extra you would have put into a whole life policy to have it last you till age 100, put that extra into an investment account that runs alongside that term policy. So let's say you have a 30 or 35-year term policy, invest the difference, right, for that time period. So invest the change for 35 years. And let's say you don't invest that with me, or you invest it yourself. You invest that in the S&P 500, you're going to garner about between 8 to 10%, and you're going to supersede whatever you had in life insurance. And you'll be able to use that account to live on in retirement. And then guess what? It'll be your life insurance because you'll be self-insured.
Self-insured. So that's a very important phrase, I think, that has to be part of an overall financial strategy. And it sounds scary, right? To be self-insured, meaning that if anything catastrophic happens, such as death, your family would now be self-insured. But you're saying that you can, instead of getting some of the other products, whole life or universal life insurance, that buying term would probably be the better way to go. And whatever the difference is between paying the premium for both of those products, and there's usually a wide gap in terms of a wide difference between how much that premium is, invest whatever that difference is, and eventually you will become self-insured because you're investing it in the market and the market grows over time. Am I getting that pretty straight there?
Yeah, you're going to stand a better chance investing it if you use an investment professional, someone knows what they're doing, than if you do it yourself. And can you do it yourself? Of course. There's numerous apps, but I always recommend, if you're going to get life insurance and talk to an investment professional, because the insurance is only one part of it, right? You don't get car insurance and then you never take your car to the mechanic. You get life insurance, but then you also have a financial game plan, an investment plan or retirement plan or what have you to run alongside that. So you have an exit strategy out of the life insurance, because the point is not to have it forever. It's to protect you in your most vulnerable time. And the illustration I like to use is when it's raining, you take an umbrella and you walk with it from your car to the building, right? But once you get to the building, you don't need that umbrella anymore, do you? No, you put the umbrella away and now you're inside, you're safe from all the rain. Life insurance is like the umbrella when you're walking from your car to the building. And that building is financial independence or retirement, whatever name you want to call it.
So do you recommend whole life or universal life at all, or do you pretty much stick with term? Is that?
I recommend whatever is in the best interest of the client. And I never tell the client what to get.
Got it.
I write out both models, what are the options they have, and I say, which one is going to give you the most money at this age? Then they choose. And which one is going to give you the best protection from now until when you have enough saved up? Now, it just so happens that the clients always choose term, or they choose to buy term and invest the difference.
Got it. So tell me a little bit about the cost, because I did hear you use some numbers there, and I'm not sure how accurate those numbers might be. But let's say on average, let's say a person is, let's just call it 30, 35 years old or something like that, and looking for a certain amount of coverage. How much will that cost them per year if they're buying that right now?
Well, it's hard to figure what that's going to cost exactly. But if you say someone who's age 30, average health, doesn't smoke, then it's, let's use a client that I quoted recently. So they are 30 and they were looking for about $500,000 of coverage. And so that's costing them $100 a month. However, they had received a quote a week before that for whole life insurance. The whole life insurance cost them $1,500 a month.
Whoa.
Yeah. So it's a vast difference. And yes, every company has a different pay scheme, But if you look in the fine print, which is the last 5 or 6 pages of that whole life policy, it explains how that 30-year-old, for the whole life policy to work, that 30-year-old has to be charged as if they were a 50 or 55-year-old for the company to bridge that gap as far as financial risk. So they have to collect most of their money as soon as possible, right? Because if you die while you're paying for it, they lose. So the only way for the company to win is if you die after they've received their money.
Got it.
And that's not a win for the client.
Sure. It definitely doesn't sound like it. So how much coverage would you recommend? And I know everyone's situation is different, right? But is there a general philosophy surrounding the coverage amount per person?
There are 2 general philosophies. One is, if you don't feel like calculating all the numbers, get 8 to 10 times your current income. Because if you pass away, or when you pass away, I should say, your family should be able to take care of everything that's necessary. Or if you want to get more calculated about it, what you can do is calculate all your debts. So it's called the DIME method, D-I-M-E. So calculate all your miscellaneous debts, calculate 3 times your current income, then your mortgage, and then educational expense for your children. And that will be almost an exact number of insurance that you need. But I find it simpler to use the 8 to 10 times method.
All right, so let's be kind of tactical about this. Let's say someone makes, let's just call it $50,000 a year, right? With the 8 to 10 times method, probably they would be looking at around $500,000 a year of coverage.
Yes.
Okay, and if someone is making $100,000 a year, then $1 million in coverage would probably be appropriate.
Definitely.
Okay. So what's the process like to purchase life insurance? Like, is it complicated? And I know that people have these fears about, oh man, I gotta contact this company. All they're gonna want to do is just sell. I don't want to feel pressured and buy something that I really have no idea about. How does this work?
First of all, talk to someone you trust. Don't just go online and go to Instant Quote and buy life insurance, right? Talk to someone that you trust, or get a recommendation from someone that you trust. And it's very simple. There's many ways to apply. Every company is different, but generally it works like this. You have what's called instant issue policies, where you answer questions. And once you answer those questions, the company takes all that information, goes back to their underwriters and calculates a rate for you and says, here's, you're covered. Here's what your rate is for this amount of coverage. But if you want to get a better price, something more specific to you, you fill it out. Typically, the company will pay for a paramedic to come out, draw your blood, take your height and weight, ask you some more questions. And then they'll send it back to underwriting. And usually 30 days or so later, you'll have your policy.
So that sounds simple enough. So if anyone's in the valley of decision about whether or not they should go and get life insurance for the very first time, we're kind of dispelling some of these fears here. Have no fear. It's a fairly simple process. Matter of calling them up or searching online, and sometimes they'll send someone out, and it's that simple. So yeah, please, if you do not have life insurance yet, please don't not have it because of any fears about the process. Process is fairly simple. So what about the payout? Now, I've never, me personally, experienced a life insurance payout, thankfully, from anyone in my family, or I've never been involved with understanding the payout process and whatnot. How does that work? Is this going to be held up in court? Do these companies play games with it? And I'm guessing that some people may have a fear about life insurance because maybe they've heard that, hey, you could pay for this and never experience the benefit if and when you need it.
In my studying life insurance, because I studied life insurance in order to properly accommodate my clients, there's a story down, 60 Minutes did an expose in Florida where a bunch of life insurance companies had not paid out. People were dead for 5, 10, 15 years, and they had not paid out. And we're still extracting premium payments from that client's account, right? And that's the scary part of it. But this is what I tell clients. If you go with a company, ask them, what is their clause? what if we move to another state and I lose contact with my agent? What is the process for paying out when I pass away? Is the company going to come looking for me? Because the company that I recommend to my clients, they actually do a social security search of that client. I believe it's 2 to 3 times a year to find out if that social security number shows up on any death records, so that then they can send someone out to find that client. That's a big difference, right? So at some point, they're going to find you within 12 months. They're going to find out who is in charge and then give that person the appropriate attention. But also, in studying, any company that in their clauses, they have the right to keep your death benefit, that's a red flag, right? If there's a clause to keep your death benefit once you've passed away, something should raise a red flag there to you. So look for companies that don't have that in their clauses.
All right. So and that's hard to hear that people are not getting their death benefit. Do you know, by the way, if this is a matter of the deceased not letting the family know where maybe the records are or the financial goings on of the home? Could it be partly due to that, or is this just like companies acting reckless out here?
It could be. However, if the company has on their standard operating procedure that they're going to send notification to the estate, then whatever state, as in like Tennessee, Alabama, your estate, meaning your financial gifts go to, that's where it'll be held. Like if you go to treasury.gov and say, hey, this amount of money is waiting for Michael Looby's family, Michael Looby's heirs, right? Then my family, even if they're 5 years late, they're going to find that that money is available, right? But if the company has a standard operating procedure that don't ask, don't tell, if no one asks for it, we're not sending it out, then that's companies, as you said, acting reckless, right? You want a company that's going to look to do right. And that's why we always take down a page of information for other people to find out. So if your spouse passes away, or you and your spouse pass away in the same accident, who then can I contact to find out what happened to your kids? Who do you trust that I can call and say, hey, who's a notification in case of emergency, so that I can get these things over to that family?
So what I'm hearing is it's very important for families to keep all that information safeguarded somewhere important, as well as sharing that information, even if they don't necessarily share all of the beneficiary info and that sort of thing. At least, hey, here's where the drawer is, where this info is. In the event of something catastrophic happening, this is where you need to look, so that you don't necessarily have to depend on a company being reckless or not. This is where it is. And, I think that's just really, really important to do that, whether or not life insurance companies are acting reckless or not. It's just important.
I would agree with you, Troy. And that's why we encourage, obviously we can't force, but we encourage our clients to give us an emergency contact, so that following that policy going into force or being accepted, I can call and say, hey, Tony Smith, I was talking to your brother, John, and he got a policy. Oh, John told me you were going to call. Great. You're my emergency contact in case I can't reach his spouse, or in case I can't reach anyone else. Are you okay with that? And that way, they now have that conversation going of life insurance. Oh, and by chance, that's going to trigger something in his brother to say, hey, I don't have life insurance. Maybe I should do that. Because we want everyone to be protected, right?
I'm going to ask a very obvious question, but I want our audience to hear it firsthand, because you've probably seen it before. What happens to families whose main breadwinners pass away without life insurance?
Oh, man. Things happen that it can be very bad. So if you're the main breadwinner, you don't have life insurance, and you pass away, think about that house. That mortgage now is not going to get paid. Think about the car. Think about your kids that may be in private school, or maybe you were supporting a ministry. All those people, all those organizations that were supported by your income, that's gone. I was even told a story by a lady that she said, my husband passed and he didn't have life insurance. And My parents lived in another state, but we didn't have any income. And so we had to move into a trailer in the woods so I could get back on my feet. And then I ended up moving in with my parents. I mean, that is a devastating story.
I've even heard of a person or two marrying, not for love.
Yeah.
But because it was a financial arrangement, they needed to be taken care of. And it's not like they were gold digging, but they just legitimately had financial needs. And the best way to take care of those needs or have someone else help to take care of those needs was to get married. And I think that life insurance serves as a hedge against desperation in those kinds of situations.
Definitely. And I'll run back to your last question as well. Delivering a death benefit, a check to a family is one of the best sensations I've ever experienced, because other people are bringing flowers, cards, condolences. Maybe they'll bring $100, $200. But when I can bring $150, $250, $500,000 and $1 million check to the family, does it dry the tears? No. But it calms the fears that family's going to have. They now know, okay, I can grieve in peace. I don't have to run back to work to make up for the income difference. I have a chance to actually grieve. I can grieve in peace with my family, knowing that our financial needs to be taken care of.
So let me get this right. You don't mail the check to them. You yourself, as a financial representative for these families, you drive over to their homes or wherever they live, and you hand them a check in their hands.
I attend the funeral, and if I can, I come with the check.
Dude, that's high character right there, man. I love hearing that, man. That's awesome. All right, so Michael, I have a personal question. So I got life insurance about 10 years ago, my wife and I, and along the way, our income has increased, and I've been wanting or thinking very, very strongly about getting additional coverage to make up that gap for the 8 to 10 times insurance kind of philosophy here. And now that I'm 10 years older, my fear is that if I want to increase the coverage, that because my age has also increased, that it's going to be out of reach to get additional coverage. What are my options here?
You have many, but I'll keep it simple. So the two general things you could do is you're young enough that you could probably fit into a 30-year term and let it ride for 30 years. And now you're going to think about putting together an investment plan over the next 30 years. So it gives you time to invest. The other thing you could do is really strategize. How can I customize this? Well, I don't know how old your oldest and youngest are, but let's say roughly 18 years before they go to university, right? Probably a lot less than that. But so let's say you get 15 year or 20 year to get them to that university age. So that E in the dime method, okay, well, I know I have 20 years there. So you get a term policy for that amount that you want to put aside for college in case you pass away too soon. Okay. How many years do you have left on your mortgage? Well, let's put a term policy in place for that special amount. Then the longest period is going to be your income, right? The I. So you're going to put away 2 to 3 times or pay for a policy that's 2 to 3 times your income over the next 30 years. And then have a smaller policy, probably 10 to 15 years to cover miscellaneous debts. So maybe car, credit card, that kind of thing. And you put those together, that's going to give you a fully customized policy to be able to manage those obligations.
All right, so I'm going to go back to the drawing board. My wife and I are going to try to figure some things out to see if, and I'm actually pretty comfortable with the term. So we got a 20-year term, and we got it, like I said, about 10 years ago or so. And I think that we'll have the ability to be self-insured in another 10 years. It's just the amount that I just kind of want to increase. But yeah, man, this is definitely food for thought. We'll go back to the drawing board and see what we need to do.
Yeah, definitely. I'm pretty confident you'll have it together.
Hey, appreciate it. I'll take it. Man, when we started the episode, I had mentioned social media influencers and what some of them have to say about life insurance, particularly universal or whole life insurance, and using this as a bank for yourself, or there's so many terms around, but it usually kind of boils down to the same idea. It irks me, but I just want to ask someone who deals directly with life insurance, what are your thoughts about this?
When I watch it or a friend sends me the video from TikTok, what do you think, Michael? And I watch it and I say, man, they typically don't ever mention specifics. Now, as a representative, unless you're licensed in every single state, you can't necessarily mention specifics to a person. But if you're going to say that one is superior to another, and you're talking about whole life insurance or universal life or index universal life, show people the payment schedule. Show people the enormous fees that they're going to pay. Show people the disclosures that allow you as a cash value company to keep the death benefit or to keep the cash value account in the client's debt. I mean, there's so many variables where the company wins and you lose that it's insane. People should definitely do what's in their best interest, but these influencers make it sound so good to bank on yourself. Why wouldn't I want to do that, right? Why wouldn't I want to have one account I pay to as my insurance and my investment? Well, because the numbers don't work out. The math's not mathing, right? And so that's typically what I tell people. Unless they mention specifics and show you that cause, which they can't do in 30 seconds or 2 minutes, take it with a grain of table salt.
What did they promise though? Like what's so endearing about what they're saying that really gets people all hyped and gets all these likes and all that kind of stuff? What are they promising?
What they're promising is that you can put money into this account, and when you need it to buy a car or put a down payment on a house, that you can do it. So a lot of the videos I see appeal to house flippers. So, buy this policy for this amount of coverage in a year or 2 or 5. You can reach back into it and borrow money from yourself to go pay for this flip. Well, you're not borrowing from yourself, because once you borrow, right? Borrow means you have to pay back. And there's no such thing as a 0% loan in that regard. So you're paying interest to somebody. And in the fine print, it says that they're using your cash as collateral. So you're borrowing from them and you're paying back to use your money. And I've seen as high as 9 or 10% to borrow your own money, right? And I know if you or I borrow from ourselves, I'm borrowing at 0%, right? Every time. But they're promising that you can reach back in. And there's no way, unless you throw down a heavy amount into that policy up front, that you're going to have enough to put a down payment on a car or a house to be able to purchase it. There's no way.
Got you. So it sounds like you're just as irked, maybe even more so than I am.
Misinformation irks me. My parents are immigrants. I'm a first-generation American. And for me, misinformation causes poverty. And so when a company intentionally misinforms, not an agent, because some agents don't know any better. They're just following what the company says. Some agents know and don't care, but neither one is a good option for a client, right? You want an informed agent that's going to tell the truth. And so to me, that's not a good business practice and not an honest practice.
So we're winding down here now, and I just want to ask a question, because someone has been listening or watching this conversation and just wondering if and when they should get things started with life insurance. When's the best time to purchase life insurance? Someone is saying, man, I'm too old. I don't have enough money, or I'm just not in that place in life. Someone's just in the valley of decision. When's the best time? What would you tell that person?
I tell someone, if they're thinking about it, talk to someone today. Even if they don't know how much they need, they're not sure, have that conversation today. Because even if you buy it today and you realize tomorrow you need a little bit more or you need a little bit less, you can always call the agent and make that change. But it's better to have it and not need it than to need it and not have it.
I'm with you. All right, so I'm just going to give our audience just a small shift that they can do. And this is going right along with what you're saying, Michael. today, like literally, it doesn't cost you anything to look into it. And I'm challenging someone who may have some sort of roadblocks, whether those are internal or external, whether those are real or perceived, whatever your roadblocks are in terms of life insurance, I'm asking you right now to make a small shift and move beyond that roadblock and just look into it. I'm not asking you to buy life insurance today, but I'm asking you to look into it, whether that's online or whether you seek a professional such as Michael or someone else. Just at the very least, ask questions. Let's see what you can get. They'll do the calculations for you. There's no pressure to buy or anything like that. So just look into it, see what it will cost and what your benefit will be. And when you do that, I guarantee you just the knowledge that you'll get from that will be so liberating that you're more likely to make a huge shift in your life, and not just your life, but in the life of your family. Michael, man, I really appreciate you being on with us today. Man, you've really given us a lot to consider and a lot to chew on. Thank you. I appreciate you.
Thanks for having me.
All right, y'all, you've heard it here. This is the StewardShift Show. We've experienced this time with financial representative Michael Looby. We'll catch y'all next time.